but we have an idea. First, I wanted to discuss with you before these effective and the nominal interest rate was the perpetuity, which the idea which we were discussing in the last lecture about the compounding interest more than frequently than annually. So we have basically categorized this topic into three dimensions. The first one was the semi-annually compounding, quarterly compounding, and continuous compounding. But we have another condition, is that when the number of years are missing, then how we can calculate the interest rate. For example, so when the number of years are missing, so that's become perpetuity. So I just wanted to discuss another topic, which is perpetuity. Okay, this will apply when you don't have any kind of information about years. So when years are missing, then you would apply. So remember that when years are missing, then you would apply the perpetuity case, and you can only solve and you can only find present value for a present for the perpetuity case. In the perpetuity case, why? Because when you don't have any information that about your n or mean the number of years, then how you can calculate the future value? So that it is always based on uh, a present value. For example, if you have a condition, for instance, first I'm just giving you a definition just to understand that what is perpetuity. An annuity with an infinite life providing continuous annual cash flow. Okay, an annuity, with an infinite life providing continuous annual cash flow. Okay, formula for that is present value is equal to r divided by I. We don't have any information about n, so we are in a perpetuity condition. So for example, let's discuss a case just to get better understanding. For example, if you wanted to receive 2 lakh, okay, if you wanted to receive 2 lakh uh, in every years, for example, for a lifetime period, okay, you don't have any information regarding n, that for how many years you just wanted to calculate, you just wanted to receive the 2 lakhs. So you have a plan that you wanted to receive, for example, 2 lakh in every year for a lifetime period. So how much you can invest today? Okay, so what is the condition? You wanted to receive how much? 2 lakh, and with the interest rate, let's say 10,000, how much you would receive, then how much you have to invest today. If you wanted to get 2 lakh with the interest rate of 10%, that means we have to calculate present value. So present value 2 lakh divided by 10%, and we have 20 lakh, mean we have basically 2 millions. So what is the condition? Condition is saying that if you wanted to receive 2 lakh every years for a lifetime period, so you need to invest 2 millions today. So that was a perpetuity case when we don't have any kind of information about number of years. So we are at our concern topic, that is known as effective versus nominal interest rate. So effective versus nominal interest rate. So let's talk about what is nominal interest rate. Okay, nominal interest rate is a rate that actually used for some kind of indication. You can't say this is the rate that you would receive in the future. No, this is not that genuine rate that you would receive in the future, but this is just a kind of a indication. Why? Because this is the interest rate which is interest rate before taking interest, not interest, inflation or any kind of a taxes into account. Okay, for example, just assuming that you have a condition, you have a commitment with the bank, that bank said if you wanted to for example deposit, if you deposit, let's say $10,000 today with the interest rate of 8%, you would receive at the end of, or you would receive in every year. Okay, in every year, for example, not in every year, for 1 year. So at the end of year one, so you would receive 8% interest rate. So how much you have to deposit today? $10,000 with the interest rate of 8%, and at the end of the year you would receive that much amount. Okay, now let's take a simple example. For example, you just wanted to buy a car. Okay, just assuming that car price is $1,10,000. How much? $1,10,000. And you just have, let's say, 1 lakh. You planned that you would deposit into the bank, and at the end of the years, and at the end of 1 year, you would receive, let's say, with the interest rate of 10%. So at the end, you would receive that amount to buy a car. Okay, so that is the commitment made by the bank with you, that you would receive 10% of your deposit at the end of the year. Now what will be the condition? In reality, might be possible the cost of the car or the price of the car would be 120 lakh. Then again you are 10,000 short. Why? Because the price of the goods has been increased, or you, on the other hand, you can say the price of, or the worth of your money by 10,000 has been decreased, because in last year the price was $1,10,000, and now today, in next year, the price is $1,20,000. Okay, so you can say this by in two conditions. That one condition is that the price of the product or the price of the car has been increased, or other hand, 10,000 price, or the decrease in the worth of money. Okay, so what is the commitment of 10% made by the bank is known as your nominal interest rate. Okay, that is actual one, but at the end, that doesn't something that can fulfill your dreams. Okay, that doesn't bring your dreams into reality, because it didn't count any kind of inflation, worth of the money. Okay, so this is nominal interest rate. So I'm sure you have a better understanding that what is uh, nominal interest rate. So what you will plan, you would ask for more interest rate. Okay, let's say the condition is that 10,000. Okay, and 1 plus I 1.08, and for 1 year, so how much you would get is 10,800. Okay, so how much interest you are earning is 800 at the end of year one. Now that was the condition when you are in a condition for 1 year, so you no need to calculate the effective interest rate. Just keep in mind condition number one, when you are in annual system, so you don't need to calculate any kind of effective interest rate. But if you really wanted to calculate, so you have to uh, convert that annually interest rate into different categories, into semi compounding, into quarterly compounding, into monthly, or into daily, or continuous compounding, if the condition is like that. Okay. Number two, if we wanted to calculate, let's say $10,000, 1 plus 0.08 in semi-annually case. So what will be the condition? So then we have 10,816. So that's mean that condition, how much we have 816 interest rate. If we divide it into quarterly system, then how much we have? 0.08 divided by 4 multiplied by 4, then we would receive how much is 10,824.32, almost 824. Now you what you are getting is that when you are at annually system, okay, 800 you would receive. If you are getting more than one time, like in a semi-annual system, if you are getting interest rate for two times in a year, then it's become 816. If you are getting it for a three times in a years, then it will become 824. If you are moving ahead, if you go on to, for example, monthly system, then you have to divide it and multiply by with 12. And if you want to receive interest rate on a basis of daily basis, then you have to divide and multiply by with 365. Okay, so now what is the situation is that effective, basically I'm just giving you a proper statement to just need to memorize that when you will calculate the effective interest rate, if it is based on year, then no need to calculate effective interest rate. But if it based on semi, quarterly, monthly or daily, then we will calculate effective hourly interest rate showing with R. Okay, and whenever you will calculate interest rate and compare it with the nominal rate, effective would be high in semi-annually, even more quarterly, and up to so on. So why this happening? This is happening because when you will receive more than one times, that's mean it is increasing the worth, or you can say it is counting our inflations and the worth of the money into our return. Okay, so if what we have to do, we have to if we wanted to calculate the effective interest rate, then what we will do is that formula is that R is equal to 1 plus I divided by M and multiply by M minus 1. So if you are in a uh, semi-annual system, then how much rate you would get is 0.0816. If you multiply by with 8, then it would become 8.16 system. And case number 2, that was the semi-annually system. So in semi-annually system, so that was a semi-annually system. And if you move on to the quarterly you will get 8.24%. Okay, by using this formula. Okay, why we do that? We basically find it to add inflations or anything with our interest rate. So that was the basic understanding about the nominal and